Just bear with me for 2 minutes, and this video will change the way you think about your mortgage completely. Most people make the assumption that mortgage rates are dictated by the Bank of England base rate, but that's not how it works. And understanding what really drives mortgage rate changes can help you make much smarter decisions. Now, I completely get it. The logic is very simple. If the base rate comes down, then our mortgage rates must come down as well. And while there is a connection that does exist, it's not a straight line as you might think. I really hear it all the time from clients and friends when they ask me how the rate's doing in the market right now. And actually what has happened in the past and in recent history is the Bank of England might actually decrease the base rates, yet mortgage rates stay static, or sometimes they even slowly creep up. The opposite has often happened as well, where the base rate has gone up, but mortgage rates have come down. So what is really causing it? Behind the scenes, lenders don't just use base rate. They use something called swap rates. Swap rates are financial contracts based on prediction on where they think the market is going to go. Not just in the next couple of weeks, but maybe in the next 2, 5, or even 10 years' time. And that's really key because swap rates are based on prediction, not just policy. So if the market expects inflation to fall or the economy to stagnate, swap rates move before banks even have a chance to act. And that's why we often hear things like the market has already priced in rate drops. They're not referring to the base rate reduction, they're referring to swap rates. And this is where I see a lot of smart people get caught out. They're waiting for a rate cut and they'll call me and say, the base rate's reduced now. Can we see where the market's at? They think lenders will follow, but actually it was already absorbed in the market weeks before. The Money Policy Committee meet every 6 weeks. And what they're looking to do is decide whether or not they're going to keep the base rate the same, increase the base rate, or decrease it. So right now, everyone's watching to see what the Bank of England are going to do. The Money Policy Committee are going to meet. They will discuss things like inflation, the economy, wage strength, and ultimately they'll make a decision on whether they need to decrease it or whether they need to increase it, or keep it the same. Personally, while I'd like to see a reduction in our base rate, I think this time round they will hold it, given the information around inflation earlier in the month. But what's really interesting, if when we go back to the swap rates, is I'm already seeing lenders have already priced in the swap rates, because swap rates have generally increased over the last couple of weeks. And so we're already seeing slight increases in average rates across all fixed rates and pretty much all products. So the next question I get is, if rates are so unpredictable and you can't just look at something like a Bank of England base rate to determine whether you think the market is good or not, what can you actually control? And what we have to get away from is trying to predict the future. There's too many unknowns, and what we need to really focus on is what is happening in the here and now and what brings structure to our situation. So things like, do you have overpayment flexibility? Is there an ability to port your mortgage? Are there any product fees that are going to negatively detract away from your equity level? Term length. Have you selected a long enough term or a short enough term given what's actually happening with you personally, not what is happening geopolitically in the world? And are you looking at balancing certainty over flexibility, especially for business owners? When you maybe have turnover or revenue streams that may be seasonal or sporadic, are you giving yourself a bit of flexibility, or are you fixing to make sure that it's a monthly manageable payment that you can make sure you can pay as a worst case? Those factors make the biggest impact on a personal level, rather than just always chasing the cheapest rate. And this is particularly important for landlords now. I'm seeing a big increase in lending through limited companies for landlords, especially portfolio landlords. And this is for both strategic reasons and tax planning reasons. And I really do expect that trend to continue and keep growing. So the main takeaway I want you guys to take away from this video is, stop chasing the Bank of England base rate to decide whether it's a good time to remortgage now, or should we wait 6 weeks to see what happens next. The swap rates are the key reason and the key thing at what determines mortgage rates and what they are. The key thing to remember is swap rates are always changing and they're not always reported. So your mortgage market and the rates that you see are constantly being adapted and changed based on those swap rates alone. So while the base rate does have a place, it does have an influence, generally, if they feel the base rate is coming down quickly, you'll often see that competition hit the market much earlier, sometimes even 3 or 4 weeks before a base rate meeting with the Money Policy Committee even takes place. So trying to time the market based on what market conditions you think there may or may not be, just remember the banks and the financial institutions have much more information than we do and you do. So just focus on your personal structure and your personal strategy, as that's going to yield you the best results. As a disclaimer, this is not financial advice. Your circumstances and your personal income will vary from person to person. So what's right for you might not be right for somebody else. But if you want to understand how a strategy can help your long-term goals, just subscribe to the channel, comment below, or reach out to me via my website.